Howdy, Jacob here. Today we're looking at Freshworks in the software industry, 5.2 billion market cap, 4.1 billion enterprise value. They are a software development company who provides software as a service products worldwide as customer and employee experience. Founded in 2010, so been around for a short period of time, and their revenue growth is astronomical. It is going down year over year. The revenue growth is being smaller year over year, but still, 20%. That's crazy. An increase of gross margin, operating margin. Still haven't found profitability, but we're going to look and see if that's a heavy amount of reinvestment in R&D. And to no surprise, it is. They are investing over 20% of their revenue is expensed as R&D. So again, taking money away from today to hopefully make more in the future. Not everything's going to hit, but the ones that do hit will likely have massive returns on investment. And those are the type of R&D that you want to be spending your money on. High rates of return, possible return is perfect. And right now, looks like from a cash flow perspective, they are making free cash flow. Probably helps that their stock-based compensation is higher than their cash from operations, meaning that outside of stock-based compensation, they're a negative free cash flow business. But put stock-based compensation in and they make money. So, might be hesitant on the reason for that, but either way, it's just going to be something that we incorporate into issuance of shares in our analysis. Balance sheet shows over $1 billion of cash-like products, $620 in cash and equivalents, $450 million in short-term investments, with no short-term, no long-term, $474 million total liabilities. So beautiful balance sheet, loving that amount of cash on hand, and for how much cash they have on hand, they're still reinvesting and doing a lot in R&D. So pretty interesting things going on there. Use of cash is mostly acquisitions and reinvestments. So let's make some assumptions here. This is going to be not necessarily my wheelhouse, these types of growth companies, but maybe I tend to be a bit on the conservative end. It's honestly fine to me. So let's say 12% revenue growth, 20 on the P, price to free cash at the end of 7 years, saying that they still have a lot of growth ahead of them. I guess I need to give me a higher discount rate since they haven't really made profitability yet. I think with an 80% gross margin, free cash flow as high as 20%, they can probably do 20 to 25%. So let's say 20 to 25%. Share change, their stock-based compensation is pretty substantial. So about $200 million. So $200 million for them is going to be about a 4% increase of shares, assuming they all get turned into all turn into issued shares. And we're saying the price needs to fall 74% before we get the return we look for here. So again, I usually am more conservative, but if you really understand this business, you're entirely confident that they'll be able to grow 20% for the next 5-10 years and be able to accumulate a more impressive margin, maybe reinvest at higher rates, then this could definitely be a good company at this price point. But for me, based on what I'm seeing and based on what I think to be a bit more on the conservative side estimates, but again, I like companies to look like screaming deals. Not quite at the price point for me. Has to fall essentially about 74% before we get the return to look for here. So hope you enjoy the video still and have a great rest of your day. Thank you.